Yeah, thank you very much. Thank you, Srishti, Dr. Parekh. Very, very nice to be here. I'm in a different country and thank you for a very nice introduction.
Thank you
In
so much, Manu sir, for agreeing to join us today. So I would like to introduce you to all our guests who have joined us today. So we are really excited to announce that Mr. Manu Rishi Gupta, the founder of MRG Capital, is with us today. He has 30 years of experience, of a senior management experience in fund management and in hospitality industry. Manu sir brings a wealth of knowledge and insight. He's an MBA graduate from Warwick Business School, UK. He specializes in corporate finance, investment banking, risk management, and corporate strategy. He launched his first informal fund at the age of 16. We'll ask more about this Manu sir, to you, achieving an impressive CAGR of 18%. He's an avid blogger, and his articles on financial markets, global macros, politics, and philosophy are widely covered in national press. Manu sir is also a staunch activist for shareholder and investor interests, currently fighting a class action sought against delisting proposal of ICICI Securities by ICICI Bank. And that's the reason why I came in contact with him on Twitter, and I really got impressed by the insights he carries. So thank you, Manu sir, and the mic is all yours.
Thank you, Srishti. So I'll use a bit of Hindi and a bit of English because, of course, Hindi is our mother tongue. Thank you for a great introduction, Dr. Parekh, inspiring. And I was telling Dr. Parekh, he has a 97% familiarity and same look as my father. So the moment I had the first video call with Dr. Parekh, I said, Dad, what happened? Because I lost Dad 2 years ago, and his beard and his chashma and his smile and his mustache is exactly like my father. So it's amazing. I'll share. I thought I'll tell you that I'll share a picture, but I'll do. So yeah, I was just trying to wonder why the last Thursday of every month. And when I was trying to figure out why everyone's trying to do the last Thursday, is it because people, the 93% people who lose their money in options and futures, they end up looking for some sort of a retribution on the last Thursday, and they call some speaker to give some degree of confidence that yeah, all's well and all will be well. So is that the reason, Srishti, that it's the last Thursday by any chance?
This sounds like a beautiful explanation. I think I'll use that in future if anyone asks me so. But
हाँ,
honestly, that was never the plan. I think
अच्छा
Purvish
अच्छा,
sir
कि
decided just randomly.
जितने भी घाव लगे हों उन पे मरहम लगाने के लिए किसी को बुला लो, इवनिंग ऑफ
Yes,
लास्ट थर्सडे.
मैं ये पक्का बोलने वाली हूँ अगली बार से.
हाँ. So, you know what? You asked me that how are you going to introduce yourself? And I've always felt, and even in my business school, one of the top professors who's also Nobel laureate, he told me, and this is a copied thing from his presentation, that power corrupts and PowerPoint corrupts even more. But in India, we are so used to a PowerPoint presentation. So I thought I'll articulate my thoughts in a bit of a PowerPoint presentation and speak to all of you. And since everyone loves a PowerPoint presentation. So just to set the context and set a bit of a perspective, the only one rule that I've learned in my life is that investing and wealth creation and wealth generation is 90% psychology, 9% philosophy, and only 1% the combination of all the Warren Buffett quotes and books and CNBC and everything. So 1% you can take from all the publicly available information, but 99% is all your philosophy and psychology. And I follow that, and I've followed that for the last 30 years, and that's held me reasonably well in my investing journey. So, everyone, and of course, some of the parts of this presentation and talk might be slightly, mildly repetitive. But let me tell you, let's talk about the good news first. And the good news, most of the people, I don't know how many of us are here, but most of the people would have heard the good news all this while multiple times. But I'll take less than a minute with all of that. The good news for all of us, considering that we've got the accidental birth of being anywhere between 25 to 55, 60 at this instance in time in India. So that's that's accidental by our luck, right? If you were born the way my father and my grandfather, where the president's salary used to be 10,000 and my father used to earn 800 bucks in his first salary, right? Those were different times. And if you could have a roti kapda makan, you would be the luckiest man on the planet, right? But today, India is where US was in the 70s. Young population, absolutely booming, a lot of people trying to educate themselves, getting out of getting out of the lower middle class to the middle class and upper middle class bracket, and and the fastest growing economy on the planet. Now, of course, I'm I'm not a Modi bhakt, but I'm reasonably neutral with everything and reasonably rational. So I do not know whether we are actually growing at 8%, and whether if we are growing at 8%, I would have assumed that my driver and my maid's salary from the year 2000, which was 3,000 then, should have been 30,000 today, but it is not. So that's a bit of a shame, right? Right, because we are enjoying. I'm sitting in London. I'm having a great time. I'm having a beer, but 70% of all of us are still struggling. But if they educate themselves as we are, and and if we do what we are doing, and if we are truly true to our statistical numbers, and if we are true to our commitment to growth and honesty, I think India is in a very, very right place. So, the fifth largest economy, we've grown exceedingly well. Year on year, we've grown. Every other economy has grown or degrown, but we've grown. And 700 million people are still absolutely in, like they're in a pressure cooker, trying to get out, creating economic activity in our country that will allow a huge economic and financial activity. Incomes are rising, and we are nearly doubling every 3 4 years. What took the first 58 years to get to a trillion, we are doing that every 3 4 years now, which is great. So that's the good news. So some more good news is the demographic dividend. Some of the best and the most developed countries. Now, I mean, I visit Britain nearly twice or thrice a year. It's an aging population. Japan has 9 million homes that don't have people to occupy them. So if you want to buy real estate at some point in time, the most beautiful home in the most beautiful location, you should think of Japan, not in Gurgaon. And I'm sure a lot of doctors are here from Gurgaon as well, because homes are going so amazingly cheap. But yeah, we are young, and we are plateauing. But at this instance in time, the demographic dividend is in our favor, and we are doing exceedingly well, considering that just Bangalore is where I live, Hyderabad, Bangalore, Hyderabad, Chennai. Just these three cities are contributing to 59% of India's services GDP, which is amazing, right? So, so I mean, when I go out to a British pub, there are hardly seven people. But in Bangalore city alone, and it's a reflection of how our mindset is and what the potential is, and that's why you could possibly buy United Spirits or Redico Khatan, because because when you go to a Bangalore pub, the number of covers available are not 100, 50, 200, 1,000 cover restaurant on a midday of a week, and you're having to wait for 2 hours. That's a reflection of the spending power and the vibrancy of our social fabric and the vibrancy of our financial fabric. So that's where we are. And well, now I read a I read a quote by Bertrand Russell that said, the problem with the whole world is that the wise, that the fools are always brimming with confidence, and the wise are always in a state of doubt, right? So when you listen to CNBC, read a book, or listen to any of the top commentators, the publicly visible commentators on the Indian front, you feel as if you would want to sell your mother's jewelry and your wife's jewelry and invest in the polycabs of the world and the RVNLs of the world, and the theme that that is the railway theme or the PSU theme. But of course, if you've been a slight skeptic all your life, you would never lose wealth. And that's what I've learned from myself. And that's why sometimes I wonder, why are you calling me to speak to so many people? Because I end up puncturing the bubble, or the bubble of their positivity, while still being personally invested 100%. Mind you, I'm not in cash at all. I'm still 100% invested. But I'm the most fearful and a skeptic guy. But let's talk about a bit of macroeconomics. And it's very important because we only listen to CNBC, and most of us are reasonably biased towards all things that are good, but never truly understand what could possibly go wrong. Eh, uh, you know, we all, whenever we leave home, I'm going to be 50 in a year and a half. But every time I get into a car or step out of the home, my mother still tells me, भैया गाड़ी धीरे चलाना, ध्यान से जाना, जल्दी वापस आना, message करना. So your mother's being a bit skeptic, right? And I get irritated with that. But the fact that you're cautious in whatever you're doing, not only as a character of your family, but also in the way you invest, also in the way you conduct your life, makes you a better, cautious, and a more successful investor. Because if you are not cognizant of the risk that lies in anything and everything that you do, then you can end up making a mistake. So, so the not so good news, and last 2 days, all of us here, it's so fortuitous that we are having this conversation at this point in time, that the global markets are collapsing. I don't know, because I switched off my three laptops around me, as to what Nasdaq is doing. But last 2 3 days have been very, very volatile for global markets. They've been volatile for Indian markets, and things are beginning to get a bit shaky. And and if somebody is following me, or somebody read my last blog, there was a concatenation of thoughts and logical explanation as to why we need to be more cautious than ever before, considering that we've doubled our wealth, or maybe trebled our wealth in the last 5 years. It's been the best run for Indian. I mean, the last run that I saw like this was between 2003 and 2006-7. I mean, everything that you would buy, everything that you would place your finger on, would double, treble in no time, right? And I'll share a few examples of those times with you in a few time. But let's come back to a few macros. The global growth is on a bit of shaky legs. US has been the liquidity provider and the greatest consumption partner for the world, whether it is the iPhone, whether it is food, whether it is exports from China and India, or services from India, because 57-58% of Indian GDP comes from services. US is the single largest consumer. 330 million people are generating a global GDP of nearly 19 to 20 trillion dollars. And we, with 1.8 billion people, are barely falsifying our data to say that we are $4 trillion. So you can imagine the kind of disparity that exists. In in the 1970s, every $1 of debt that US created would generate nearly $7 of GDP. Mind you, just $1 of debt. We're all of us are very wise people here. US is very indebted country, right? So we all keep hearing about the US debt. $1 of US debt generated $7 of GDP in 70s. Today, $1 of US debt is barely generating 48 cents of GDP. That's where US has reached, right? So if US is the harbinger and the bandwagon of global growth and global invention and global everything, then US itself is in a bit of a spot of bother. Uh, inflation all across the planet is a lot more than what we feel. I mean, by the grace of God, if our roti kapda makan is sorted, we don't really face inflation. But my mother tells me that, Bhaiya, I'm not going to give you some onion today because onions have become expensive. Or we are cutting down on our salad consumption because the tomatoes are 200 rupees a kilo. So inflation is another thing that world must keep an eye on. Even though the data says that inflation is stable, I think inflation is yet to show its true colors for all of us. China is definitely slowing down, and we all know that despite the fact that Chinese economy is reasonably robust. I mean, I've been to China a few times, and you would realize that we are not able to sort out our Gokle Bridge. But the number of years and the number of mistakes we committed to misalign the Gokle Bridge, they can create a city in that much of time. And yet they are slowing down, right? They're slowing down. The world is slowing down. So if we, in today's time, and I'm just digressing from the concatenation and the flow of this presentation, if we are saying that India is growing at 8% and whatever, and we are doing exceedingly well, we cannot be outliers from a global perspective. There's a beautiful book by Thomas Piketty. He's a Nobel laureate. He's written a book called Capital. It's a very thick, complicated book, but if somebody has interest, the world has only grown at about 4.5% over the last 400 years. So if reversion to mean and global averages is anything to go by, the world is growing at 4.5%, 5%. It will continue. All countries that are growing at 8% will come down to 4.5%. Africa and the so-called countries which were growing much slower will become bandwagons of growth for as we move forward. So if the world itself has grown at 4.5%, an Indian company trading at 100 PE doesn't make sense, right? And of course, there is always a logic about growth and CNBC pushing the narrative of higher valuations. But I think if you see US, if you see India, everything eventually reverts to mean. And I think reversion to mean might be a slightly underappreciated aspect of our investment decisions. But but just on a lighter note, when my wife Geetika is very, very angry with me, I know she will revert to mean, and she'll be okay with me. And whenever my wife is extremely good with me, I know she'll be normal and she'll go up to be her usual self. And with due respect to her, I love my wife, and so everything reverts to mean, whether it's human behavior, whether it's valuation, whether it's anything at all. Everything eventually reverts to mean. So we are right now 2 or 3 standard deviations as a nation, as valuation, as stock markets out of the thing. Uh, Out of the usual averages. Uh, we've got geopolitical uncertainties, and right now, if I was Xi Jinping, I would have already invaded Taiwan primarily, or maybe it might just happen before US elections, because US is in a state of slight disarray. And we are talking macro because all your micro decisions, whether tomorrow morning you're buying Pidilite or Asian Paints or whatever, has to be has to be based on a broad knowledge of what is happening on the planet. If you are only basing your investment decisions on very, very micro factors while being completely oblivious of macro factors, you'll end up making a dramatically stupid mistake at some point in time. You can have a very good short-term run, like right from COVID till today. Anybody, you could throw a dart and you've double, trebled your money. But if you continue to throw darts at your investment decisions and making decisions by throwing darts, you will definitely end up destroying your wealth permanently. So of course, we all know what's happening in Israel. We all know what's happening in Ukraine. We all know that Donald Trump himself wants a weaker dollar. He wants to make America great again. And not everyone appreciates Trump, but Trump wants to run America like a CEO. Now, if somebody is well read, if somebody is read Adam Smith's Wealth of Nations, if somebody's read, uh, global books on macroeconomics, if somebody wants to actually make his or her country great, they become protectionist. We all must ask ourselves a question right now, because we are still 4, 5, 6 months away from the elections. How is India going to pan out? How the Indian market is going to pan out when America becomes absolutely protectionist? And unless some huge tragedy happens, Trump is going to become the next president. So we need to ask ourselves a question. Even if we leave some money on the table, even if we are not able to uh, uh, kind of buy a share which doubles in the next 3, 4 days, it's fine. One of the things that I saw in the last 2 days is that the Japanese yen has appreciated by nearly 10%. Now, the yen in the last 1 year, 1.5 years, has been more volatile than a cryptocurrency. In 1.5 years, it first depreciated by 65%. Imagine rupee depreciating by 65%. That means the 80 rupee to a dollar suddenly becomes 130 rupees to a dollar. That's how yen, which is the second most largest and powerful currency on the planet, has depreciated. And in the last 2 days, it has appreciated by 10%. So the point that I'm trying to make here is that Japan, for the longest period of time, last 20, 30 years, had very, very benign interest rates. You could borrow money in yen at nearly 0 to -%. -% means you borrow and you get paid to borrow, and invest in all the asset classes on the planet. You could buy American real estate, you could buy American equity, you could buy Nvidia, you can send money to India, buy Indian ETFs, buy whatever you want on the planet by borrowing yen. Now, yen has depreciated because of overprinting. And Japanese inflation, which always used to be a deflationary environment, has nearly hit 3%. Now, can you imagine a country where the interest rates are 0.1% and the inflation is nearly 3% now? What happens to yen when the Bank of Japan, and that's why I call it the canary in the coal mine, because that one single thing, risk will not, in my opinion, and I can be wrong, but risk will not come from India, risk will not come from the US, risk will not come from CNBC TV 18. Risk will come from the Japanese yen. When Japanese central bank begins to start increasing interest rates, and all the trillions of dollars worth of yen that has gone out to the all over the planet to hyperinflate the global assets. When that begins to unwind, what is going to happen? So you can all Google what is the reverse carry trade and how it will all pan out as over the next few months, and what ramification it can have on the global markets, what ramification it can have global asset prices. I can't begin to imagine that the Japanese yen lends to the US dollar, the US dollar private equity money comes to Nika and what were the great three IPOs? The Nika and the Mama Earths of the world and the uh, Paytms of the world. All of these people and these employees that suddenly become worth 10, 20, 30, 40 crores, they start buying real estate. And a flat and an apartment where the intrinsic value of the flat is only 4 to 5,000 per square feet starts selling at 50,000 a square feet. We all feel good because the DLF share is going up. But DLF share is going up not because there is an internal demand, but because external liquidity is coming into all the global assets, and people are making obscene amounts of money from thin air, from absolutely nothing, and inflating the price of a DLF apartment. Because we all hear, the reason I've got nothing against DLF, the reason I'm mentioning DLF is because it's always in news. They sold an apartment for worth 100 crores. They sold an apartment worth 80 crores. Mama Earth's founder bought an apartment in Camellias at 100 crores. Now, all of this, the real intrinsic value of building that per square foot of an apartment is never more than 4 or 5,000 bucks a square foot, even if it's a high rise, maybe 6,000. But 6,000 worth of the thing intrinsically selling for 60,000 rupees a square foot, there's something not right in the way we are pricing our assets. So, so you need to be conscious of that. I'm not going to tell you, or I would not like to be very, very blatant enough to say what might happen. But every prudent investor must ask himself or herself a question: what happens when a 10 rupee thing gets inflated to 100 rupees or 200 rupees or 500 rupees? So that's important. So when Japanese reverse carry trade begins to the begins to unwind, what will happen to the global asset prices is something that you all, and during the question answer session, if you have a specific question, I would love to share my opinion on all of this. So all is well. All is well was a was a dialogue in Three Idiots where Amir Khan was doing all is well. But it's life is not that easy that you just thump your chest and say all is well, and things are well. And I think that all the markets on the planet are in a bit of a defiance mode. Valuation is not mattering at all. This evening I was watching, I watched CNBC only to get amused. And they were saying that this company, pharmaceutical company, it came out with results. It was a market darling. I'm forgetting the name. No, it was a real market darling till about a year ago. It came out with the results, and its profit dropped like 80%. Was it Newland? No, not Newland. Anyway, the name would come back to me. And the profit dropped 80%. And the stock was 6 to 7% down, but the management suddenly comes online and says, no, in a couple of quarters, we are going to be great and we'll do well and we'll revive. And suddenly it was 6 to 7 or 10% up. So when markets start pricing assets only on a verbal commentary by management, because you're not answerable, you're not accountable. If you utter a word and if you don't go right and go wrong, there's no law on the land that makes you accountable, or you can be held to account, right? So suddenly, because there was a commentary, Mangalam Malu said, oh my God, what a great commentary, and the stock was 10% up. So when asset prices start moving 20% in a single day, either side, only discounting and accounting for some commentary which has no accountability in any court of law, that means something is not right. There was a time when I read my economics, and when I went to college, we would say, cash flow to market capitalization. We would say revenue, or actually not even EBITDA. EBITDA is all a fugazi and a fraud. I consider profit after tax as the real thing, because what is left behind in the company is all that matters. So a PAT to market capitalization. Today, a new ratio has emerged. It's called commentary to market capitalization. It's called order book to market capitalization. Anybody can give any order to anybody, whether it's executed. You cannot reprice assets on commentary and order books. So most of us investors here, if we get very chuffed about order books and commentary and future. Now there's another thing called the called the this shipping theme, the Mazagaon dog, this, that, and all. US has 11 aircraft carriers, the most powerful, you know, military force on the planet has 11 aircraft carriers. I think UK has two or three. It takes, we could barely repair. It took us 10 years to repair Vikrant, INS Vikrant. Barely repair, which was bought as a second-hand ship from, I think, Russia. And still, it is having all sorts of problems. So how many aircraft carriers will Mazagaon or Cochin build? I've seen the Cochin shipyard. I've seen a lot of shipyards, because I built some small ships in my working life and career as well, and I know a little bit about shipping. There is hardly uh, one dockyard in this entire country to actually carry an aircraft carrier in a dry dock. And building a dry dock to berth an aircraft carrier is hundreds of thousands of or billions of dollars. So how many aircraft carriers can Mazagaon dock or Cochin shipyard build, when America in its 100 years could barely have 11? Right? So the commentary is the most dangerous thing for new age investors. And that's very important to know, commentary and order book. So not so good news continued. We all know that Indian SIP is going through the roof, right? 20 lakh crores or 20,000 crores every month. I don't even follow these numbers, because a middle class guy like me trying to do a roti kapda makan, I can't even figure out what 20,000 or 20 lakh crores is. But Indian middle class is now in cashing their fixed deposits. We all used to have this concept that we must have 2 years of cash. We must have fixed deposits. Now banks have no money left. Everyone thinks the stock markets only go up. And so many of my cousins and my friends, अरे मनु यार, तुम तो हमेशा घबराए हुए रहते हो. हमने तो हमने तो अपनी बैंक एफडी निकाली, आरवीएनएल में लगाया, और वो पैसा डबल हो गया. I mean, when a normal guy who's never ever invested in stock market says that I broke my bank FD or my corpus for the rainy day and invested in Mazagaon Dock and RVNL. I have nothing against these companies, and these are just examples. And my money doubled in 6 months. What are you doing? What kind of a fund manager are you? What 17% of CAGR you are talking about? We are talking about 5 of my clients who only started investing in the last 4 5 years are now aspiring to become fund managers. They have less than 5 years of experience. I've returned their money back because I can't handle their excitement. I can't handle their aspiration at all. And I'm happy to do that. And just digressing, I've added one very fine print for all the clients who onboard with us, that in case I do not find you fit to be my client, I have the right and the freedom to sell your portfolio and credit your account without asking you within 24 or 48 hours. And people sign on that because I cannot handle people's excitement where everyone wants to double their money 6 to 8 months. The world is growing, as I said, at 3.5, 4%. India is growing at 8%. So listed companies in the best case scenario will grow at 15 to 16%. अभी थोड़े दिन पहले there was an example that I think some shipping company got an order for 187 crores. Only 187 crores. That was also an order. That would have got executed in 5 or 7 years. Whatever business you do, if you make a 20% margin, they would have made 20, 30 crores. And on that order, the market capitalization of that company went up by 2000 crores. So something's not right, right? A company that might make a 20 crore profit in 5 years on that order had its market capitalization revised by 2000 crores or 12,000 crores in a matter of 1 hour, just on that order book. So something's not right with the Indian market, right? So guys, whoever is a middle class guy like me, do not sell your family's silver to invest in risky assets. Read well, invest well, analyze well, and the joy of leaving some money on the table by having a control on your greed is great. The other thing that people that's happening in India is that, of course, government is creating a lot of debt on taxpayers' money, which is called the fiscal deficit. But foreign direct investment has gradually declined in the last 10 years. There's not too much of money coming in. The foreign exchange reserves that are coming into country are repatriation because Indians are doing very well abroad. So they're sending money back home. Again, to buy risky assets. But FDI is not going through the roof as we would all expect. We all know the gory scenes when hundreds and thousands of people walked back to their villages during the COVID times, right? They did not have food and there was a lockdown, and those pictures and those scenes are still very, very vivid in our memory. And 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 those people have still not come out of the COVID shock. So just the top 3-4% of us who know about markets and where the assets have got repriced, the real estate has doubled. We should not forget that if 70% of the country is still suffering, you have to ask yourself, has your maid's salary doubled every 5 years? Because if inflation is 8 to 10%, then your maid's and your driver's salary has to double every 5 years. That which means that if your driver's salary was 20,000 in year 2000, it should today be about a lakh. If it is not a lakh, then the broad country is not doing well. And if the country is not doing well, then a handful of us doing exceedingly well cannot sustain, or rather, let me put it differently. We doubling our money every year cannot sustain. So we need to kind of tone down our expectation. We need to be rational in what we expect from our investments in listed companies. I live in Bangalore, and a lot of senior guys from top IT companies are my very close friends. They're my neighbors and my friends, and we have a drink very frequently. Just in Bangalore city alone, in the last 1 year, 200,000 people just amongst the four top companies, Infi, Wipro, TCS, HCL, and a few others, tier companies that are between tier one and tier two. All of these companies, nearly 200,000 people have lost their jobs. They're just not employable anymore. So whether this can be attributed to AI, whether this can be attributed to whatever, I do not know. I'm not a techie to truly understand. But in a Bangalore city alone, if people are losing their jobs, they're not finding, right? If Flipkart is not giving an employment to a fresh graduate at 12 lakhs, and they are still not finding the old job at Wipro and Infosys as a fresh engineer, even at 4 lakh rupees, then something needs to be skeptical about. And we all know in the last couple of weeks what has happened to banking, what has happened to most of the companies where margins have suddenly started shrinking. And it is slowly reflecting on our balance sheets, on our share prices, but we are in a state of denial because the buy the dip, the entire concept of breaking your family, selling your family silver, breaking your bank FD, investing in ETFs and mutual funds and your SIPs and increasing all of that, thinking that the market only goes up, is it would give a cushion for a while unless somebody says that the emperor is naked. I think all of us have read that story when we were, I think in fourth or fifth or the sixth class. The emperor is naked. So it's a great analogy to say that unless somebody calls out, we are all feeling that the emperor's new clothes are actually very pretty. So Srishti, give me a feedback. Is my flow right? I mean, we are having a very casual chat. It's a monologue right now before we go into a question and answer session. But is the flow all right, or would you like me to?
The flow is wonderful, sir. I think we all are enjoying and understanding your concept. So please go ahead, sir. Don't break your flow.
Okay, lovely. Dr. Parikh, we are good? All right.
Absolutely perfect.
Okay. So I think one of the, since I'm also a group of another set of, as I said, ENT surgeons, and some of them might have joined this. I don't know how many people are here right now. Some of them might have joined here, and I've been a part of that group, and I've always found that doctors are very intelligent, right? Because if you've cleared your various examinations and all, you guys are like the 99th percentile in your intelligence and in your awareness. So many of my doctor friends are great in technical analysis. They've read tens of books. They form very strong impressions, and they eventually become great investors as well. And it is great. But I think there is no baptism unless baptism is by fire. So unless somebody's seen a bit of Harshad Mehta, unless somebody's seen a bit of 2000 crisis, unless somebody's seen of a bit of Ketan Parekh scam or the 2008 great financial crisis, I'm inclined to believe that intelligence should be used with a bit of skepticism, because intelligence always makes us overconfident, right? Unless you've seen your portfolio go down by 50, 60, 70%, and then suddenly getting re-rated. My worst time in my life was when I took a sabbatical after 13 years of working. And it's just a small story. I worked for 13 years, 13, 14 years. I was at the top echelon of my career then. And I appeared for my GMAT to go to Warwick Business School and took a sabbatical. And that was September of 2nd or the 3rd. And 15th of September 2008, Lehman crisis happened. And I was in a debt of 2 crore rupees, left my previous life. I became a student all over again. And whatever little portfolio I had after selling all out, everything, every day was getting down by 20% because circuit after circuit after circuit. I don't know how many of us remember what happened in 2008. So, and at that point of time, your portfolios were not large, right? They were small portfolios. So how many of us truly believe that there can be 4 circuits a day? And believe you me, the COVID circuit was not a circuit. COVID was a true black swan, which went down, came up, or whatever, and markets were. A circuit is when there is a systemic issue in the financial world. Now that takes years and years to recover and recoup. So whenever all the investors here, all the doctors, you put your head on your pillow every night, you have to ask yourself a question. Am I ready to handle 2 or 3 circuits tomorrow morning? What if there's a nuclear war? What if there is another something? I think the sheer run from September, October of 2020 till today has just made all of us extremely careless, extremely you know irresponsible, and extremely what you call greedy with respect to our expectations, because we've conveniently forgotten that if a company grows its revenue and profit by 20%, then logically its share price should grow by 20%. That's how the world moves. And that's the reason why we must invest in those companies where 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 we feel that they can continue to grow at nearly about double the GDP growth rate. So 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 yeah, that's what it is. And as individual investors, what you also must understand and ask yourself a question every day is, do you want to drive a Ferrari at 400 kilometers an hour, not knowing what the speed breaker is going to be, whether the road is going to be, there's going to be a gadda on the road because it has rained and it's an Indian road, and 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 with less than 50 centimeter of clearance, what happens when you're driving a Ferrari at 300 kilometers an hour? Right? So whether you want to drive a Ferrari at 300 or you want to drive a reasonably comfortable car at 60 and not be worried about speed because that you might have an accident, is something that the choice that you all have to make. If you're young, if you have tons of money that you've inherited or whatever, and you like to gamble, go for the Ferrari. Go for your expectations that your money will double. Some of my new clients say कि यार वो मोतीलाल ओसवाल ने तो बोला हम तो आपका पैसा हर साल डबल कर रहे हैं. मैंने कहा मैं तो अपना बिजनेस, आई एम रेडी टू शट डाउन माय बिजनेस एंड गिव ऑल माय मनी and move my money to Motilal if they're doubling money every year. I mean, I don't want to work. I don't want to read. I just want to be in England and having a beer in a great, nice pub. I just cannot take risk. And if somebody is doubling my money every year, or if some fund manager is doubling my money every year, so be it. I don't want to work for the rest of my life. So, narrative and reality, you have to figure out as individual investors what's the difference between the narrative that somebody is selling to you to accumulate your money, to increase one's own AUM, assets under management, and what risk that guy is taking at the cost of your money. And most of the investors, we are all great buyers, but we are never good sellers. One of the things is that some of us might be from farmer families. And if a crop is not harvested, when the crop ripens, the crop nearly always rots. So every crop must be harvested. Every crop must be enjoyed. What is the point in having the world's most beautiful mango tree if you're thinking that a mango will continue to remain there? You have to pluck the mango, enjoy the mango, gratify your life. If your portfolios have doubled, if your portfolios have trebled, if your stocks have become 10x, either by luck or by strategy. And mind you, remind me to talk about luck and strategy, because most of us generally misconnote our luck as a strategy. Just because we were lucky, we start thinking that we were lucky. We were not lucky. Whatever happened to us was a result of our strategy. No, I think in 99% of the cases, we misconnote our sheer luck as a strategy. I'll give you a small example. I used to run casinos as well, and in one point in my life, so I've done nearly everything in my life, and the people who are high rollers are called big boys in casinos. And if you do a red and a black, and I'm sure you all know math and law of probability, no matter how many times you've continuously got a red, every time the dice is rolled, the probability of getting a red or a black is 50%. So there is no pattern. There is no pattern at all. And if the probability of doubling your money on every red and black is 50%, believe you me, you have a better chance in a casino than in Indian stock market right now, especially if you're investing in PSU stocks or whatever. And we can talk about PSU stocks if you ask me a question a bit later, because I think I'm just enjoying this conversation and I'm taking too much of your time, but I'm not sure uh, how much time we have. I'm not even keeping a track of time. But but the other big mistake that most of us do is FOMO. We all know fear of missing out. Now, now I have a very, very dear friend, Ramandeep Verik. He's a professor in PGI, Chandigarh. And I don't know whether he's joined us today or not, but he was threatening to join us in this call. He's my childhood friend. So we bought SJVN. SJVN is a very talked about stock. Satluj Jal Vidyut Nigam. We bought SJVN at, I think, $20 many, many years ago. When it was $20, I knew that once a dam is built, the water flows through it, it generates electricity. So once the capex is done, which takes 40 years to amortize, SJVN is generating nearly 60-70% of its revenue gets translated into its EBITDA, or rather profit before tax. But people identify, and at that instance in time, the dividend yield of SJVN was 10%. Now today SJVN has become $150, right? We've sold it. We've sold it because now the dividend yield is less than 1%. A fraud company like ITC is giving a dividend yield of 4%, right? Why would you want to be in a SJVN? After all, it's not doing any cutting edge. It is dependent on rain. It is dependent on water flowing through its dams, through its turbines, generating electricity, and then collecting the electricity from various states. The bill, the cash flows might be stinted. So I can't, for the love of anything, I can't figure out why the SJVN now, with less than 1.5% dividend yield, should trade at $150. So that's how reasonably good companies, there's nothing wrong with SJPN, but reasonably good companies, because of human greed, has got those assets have got overpriced to a unsustainable level, right? And everything will eventually have to revert to mean, because I can't figure out that a company that's dependent on rain, and rains also, we know either it's a flood situation or it's a drought situation, generating electricity, collecting money from straight electricity boards. How can SJVN be $140, trading at some 20-30 PE? It should be trading at 5 PE because it's a utilities company. And a lot of new strategies are coming under, a lot of people are talking about momentum strategy. What is momentum? Just because, 10 or 100 people start pushing a broken bus down the hill and it gathers momentum, that doesn't mean that the bus is a Volvo bus that can operate on its own. Momentum in today's time and at today's valuation is nothing but too many people chasing too less available asset classes and driving their asset prices up through the roof, and they call it momentum. Momentum is only when there is liquidity in the market, and liquidity can actually dry up overnight. So I can't understand what momentum is. There's a whole new science behind momentum. There's a whole new science behind breakout. I've heard this breakout. The 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 share is breaking out after 10 years. Now, I don't know how many people ask themselves a question. Is it generating free cash flows? Has it revenues become sustainable? Has it developed a moat around itself? What is breakout? When too much of money starts flowing into too little avenues available for investment, anything will break out. So does that mean that you're going to sell your mother's jewelry to invest in a breakout stock. How can breakout be a strategy unless the company is really turned around? Unless the company is really making free cash flows, and if it's making free cash flows, it should be sharing that money with its shareholders is in the form of dividend. That dividend is the single most important reflection of the health of a company. No order book, no revenue, no EBITDA, adjusted EBITDA. I mean, can you imagine Nika trading at 60, 70,000 crores? 60, 70,000 crores of market capitalization is not able to generate 20 crores of PAT. I mean, the biggest Ponzi scheme on this planet is right now these 4 or 5 companies where we all think that I don't know what's going to happen to this, to the world and to these companies. And some of you might even disagree with me, but I say I have survived 30 years because I'm a skeptic. I'm still 100% invested. In some cases, I'm 120% invested on my conviction bets where I have been where I have my absolutely strong conviction. So just to tell a little bit about uh, coming back to Ponzi schemes, if 20,000 crores of monthly money, that's all people savings, fixed deposits going into stock market, where are the equal number of good companies to absorb that capital? So what's happening? 99% of the fund managers are buying HDFC, ICICI, Kotak, and Asian Paints, the handful of companies, the Reliances of the world, the ITCs of the world, and their valuations have now started trading 40, 50, 60, 70. Hindustan Unilever. I mean, can you imagine Nestle came out with the results? Such an amazingly large company. But Nestle should be trading, if it is growing at 2, 3, 4%, it should be trading at 7, 8 PE, not at 100 PE. If Unilever is growing, barely struggling to grow 2, 3, 4, 5, 7, 8%, whatever, it can't be trading at 150 PE. Same is the case with Adani companies or whatever. How can a company, we all know and you all are wise guys, that P means how many years does it take? All things cateris paribus. It's a Greek. It's a Latin. It's a Latin term. Cateris paribus. All other things remaining constant. What is the company doing? So cateris paribus. If a company is only growing at 4, 5, 6, 7%, that means it should trade at 7, 8, 9, 10, 11% PE, not at 100, 200, 300 PE. How will it be sustainable? Cateris paribus, it will take you 100 PE means it will take you 100 years for a shareholder to really generate that kind of a cash because people have stopped talking about PE. People have stopped talking about PB completely. I mean, they say, oh, it's a very irrelevant, it's a very outdated ratio because we all need a narrative to justify our bias. What is our bias right now? Stock markets never crash. Every dip will be bought till it is not, and the markets only go up, and we must double our money every 2 years. So, whatever it takes to justify that narrative, we investors end up doing that. But, but talking about my conviction or whatever, uh, I 80% of my wealth is invested in just 3 positions. And I'm not going to tell you all of that because I don't want you to follow me because I have risk management concepts in place. Just three uh, scripts or 3 asset classes, just 3 simple line items in my entire portfolio, 80%. I might be owning like 100 companies, but one share each so that I can get their annual report, I can get their feedback. It pops up on my radar. But 80-90% of all that I own is invested in just 3 asset classes because at this instance of time, I'm uncomfortable. And for my clients, 80% of our wealth is in just 5 or 6 asset classes, asset or companies. So that's That's how we manage our wealth. So one of the most important questions is, how does anybody really do it? What should an investor really do to build a portfolio? So one of the things is that never be in a hurry. The joy of leaving a lot of money and opportunity or FOMO on the table is very, very empowering. You know, the whole world is making money, and I'm happy not making money, because that's psychology, as I mentioned earlier. 1% is technique and all the books on the planet. 90% is psychology, 9% is philosophy. I'm very happy growing my portfolio, even when everyone else is doubling their wealth every 2 years, at a consistent 15, 17% a year. If I'm happy doing that even in this time with absolutely negligible risk. And I'll show you a small slide and as to how we manage our client money as well. And most of you, you can ask me a question about Sharpe ratio and how do we calculate risk. We, I, I don't like to take risk, or I like to take very, very minimal risk. I don't like to have a heart attack every day morning seeing a red or a green candle. And I'm very happy to only consistently grow with half the risk at 15, 17% year on year on year when the world is doubling their money every few months. And that's the maturity that we all must try and develop. If I want to enter a company, I would just buy one share and then watch it for for quarter after quarter, week after week. I mean, I don't know how many of you are aware, and I'm sure everyone knows Warren Buffett and have read everything about him. Warren Buffett's 52% of Berkshire Hathaway is invested in Apple, and he invested it just 5 years ago. So it does, if you are invested in a good company at a good valuation, at a good entry point, at a good time, it really does not matter at what level you invest and how you invest or what. What matters is that, sorry, what matters is that you you must be patient, you must you must evaluate your investment decisions very, very carefully. And what we discussed, I mean, I'll give you a small example. I've had a lot of personal interactions with Mr. Narayan Murthy, who's the founder of Infosys, because I wrote a blog about him. I don't know how many of you are aware that there was a time when Vishal Sikka in 2017 had created a lot of ruffle, and Mr. Murthy was not terribly fond of Vishal Sikka. He was against Mr. Vishal Sikka, and he was quite vocal. A lot of people criticized Mr. Murthy. So I wrote a blog, and it's there in public domain, about Mr. Murthy. He sent me a thank you note, then I went and met him, and I've had a few interactions with him. I realized that, a company where the founder is so truthful, so attached to his company, that company will always remain in good hands, or the culture of that company would always be great. So we bought at the peak of the Vishal Sikka crisis the Infosys share for our clients at $700. I remember $700. After that, it gave a 1:1 bonus, so it became 350. So technically, our acquisition cost was 350. 350 in 2017, despite of all the ups and downs, it went on to 1300, went to 1900 in level. The reason I remember this figure of 1911 was because a few of our clients were buying a house and I had to redeem, and I was personally selling at 1911. After 1911, it came down to 1300, and now it's back to 1800. So 2017, 2024, 350 to 1800 today, some 1800 odd. It's not bad. So patience, good company, good, and it's also given a lot of dividend in the meanwhile. So the thing is, if you're in a good company, you'll be fine. But today, a lot of people, I mean, I have a dentist in Chandigarh because I have a house in Chandigarh and I've partially spent some, we've got an office and we spent some time. I once was spending some time with a dentist. He could teach me the virtues of investing in Yes Bank, Suzlon, and Vodafone. His entire wealth, extra cash flows, were invested in just three companies. And he literally ridiculed me when I questioned him what was the rationale. He says, no, 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 these companies are turning around this. No. I mean, anybody who knows Suzlon since 2003, 4, 5, who's seen the conduct of Tulsi Tanti, I don't know how many of you even know that name, and I know it by heart. I mean, it was at six, $700. And today, again, the momentum and the breakout and the turnaround and the profit, all those narratives have started coming back, whether it's Vodafone or Suzlon or Yes Bank. I mean, I wrote a blog and I publicly declared that Yes Bank is going to go bankrupt. Some three when it was $400, it did a QIP at $410. Eventually came down to 5, and now even now it's 2025. So imagine the kind of wealth destruction. So if you have a short memory and do not have a long inner perspective, you do realize that if Yes Bank has moved from 10 to 25, you feel your money is doubled. But you do not realize that there was a reason why it came from 10 to from 400 to 20 or whatever. So that's where we are with respect to how we research companies. I personally, and that's my style, I absorb 99% information and take 1% action. All the time I'm absorbing, reading about companies, macro, global indicators, because we still might feel that Viksit Bharat and 5 trillion, but what is 5 trillion in a global scale? We have nothing. Our per capita income is still the lowest in the world. 5 trillion does sound, but 5 trillion spread over 1.8 billion people is nothing. So we are doing good. There's no doubt we are growing at 8, 9%. We should keep growing at 8, 9%. But we've got a long, long, long way to go. So be skeptical. That doesn't mean that you should be in cash. Be in good companies, but do not be greedy. Be happy with your 15, 17, 18, 19% return. If you have one good hit, one good run where you've doubled your money or 10x, 20x, whatever, it's fine. But don't construe that as a strategy. That is luck. The moment you start construing your luck as your strategy, that's where the trouble happens, especially for investors who've entered the market after 2010 and 11. I ask myself three questions and ask those questions for me, myself, and my clients as well. Naira is my 6-year-old daughter. When Naira has grown up, which companies will still be in existence? If tomorrow the stock market was not operating, am I happy to hold that company? If tomorrow a nuclear war happens or a COVID happens, is it okay to have that company in my and my client's portfolio? If the answer to that is yes, it's fine. Otherwise, don't even try and do a hit and run. Okay, no, 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 I'll do a hit and run. I've just caught the momentum. I'll make my 10%, 15%, 20%, some momentum strategy, and I'll get out. Doesn't work. One day, every momentum guy and every breakout guy will get so badly stuck that those guys will be stuck for the next 10, 15 years. And that's not a position that any one of us want to be. If you are investing 5 or 10% of your total net worth in very, very risky asset, it's fine, because then you're like gambling. It's fine. And the last thing that I ask myself is, if a company is paying even 25 paisa dividend, it's a reflection that that company, after all the line items below EBITDA, is able to generate some free cash. If that company is generating free cash, it's fine. That means the intent of the management is good. But if that companies cannot even pay a 25 paisa dividend, I'm not investing in that company ever for me or my clients. So that's the other important parameter and metric that I follow. How are we on time, Srishti?
So we are good to go. We can take couple of questions
Okay,
once
so
you've presented.
let's
Yeah.
let's wind up. Let's wind up very, very quickly, right? Because I think it's been a boring. Because when I start speaking, I get passionate, and I. The other thing is that which I mentioned just now. Not knowing when a tsunami will come is fine, because only God knows. But if you do not even know what a tsunami is, and that it can actually come while you're on a beach and having and basking in one of the finest and the most beautiful beaches, that's stupidity. And as investors, we must be aware of a financial tsunami. You know, historically, recessions and booms and busts happen every 8, 9 years. We're already 7, 8 years too late. We're already 7, 8 years too late. So be cautious. Caution will preserve your wealth, right? And if going forward, and if you've doubled your money or trebled your money or 5 times, you've made your money 5 times in the last 5 years, if going forward you can manage a 10, 15, 20%, and you can greatly reduce your risk in your portfolio, you, mark my words, will be the luckiest people. Stick to the basics when you're selecting a company. I recently, in the last 2 years, we've invested a lot in gold and silver. Now, today, all the fund managers are trying to tell us that we must invest in gold. That's a part of 20% of our client portfolios is nearly in silver and gold, and not from today, because right now it's volatile. But we invested in gold when it was 1600, and we invested in silver when it was $22. Today, of course, it went to 32 and it's 27. It's fine. But 22 to still 27, 28 and gold. So 2 years ago, we realized that the world will start having a change of the global financial order, and precious metals are going to do well. And we shifted a large part of our portfolios to precious metals, right? We stay away from businesses that we don't understand. Cyclical business, something happening in Brazil, whether the coffee crop is good or not, and coffee and Tata Consumer and Tata Tea, one bad rainfall, one good rainfall, Tata Tea can go up and down. I mean, do not try and time the market, guess, unless you are a commodity expert. Stay away from the narratives. You do not know suddenly when the coffee prices can go up. You know which is the best asset class that has done exceedingly well in the last 5 years? Orange juice. I don't know how many of you are tracking orange juice prices. Orange juice has been the best performing asset on this planet in the last 5 years. Not SJVN, not RVNL, not Nvidia, orange juice. So unless you understand, do not invest in commodities. And we talk about that do not construe your luck as your strategy. That's what I keep telling everything. If you're driving at 300 kilometers an hour and you're still able to not have an accident, you're lucky. That doesn't mean that you become a Formula One driver and you're not taking any risk. So be very, very cautious about risk. I just follow 2 or 3 things in all my portfolios, my portfolio, our family portfolio, and our client portfolios. What is the Sharpe ratio? I think everyone knows it, but I'll just very, very quickly explain to you. Sharpe ratio is the risk adjusted return. How much risk you are taking to generate that return. Very recently, we always publish our Sharpe ratio in our client communication. But SEBI, Madhavi Puri Buch, recently said that all mutual funds must declare the beta and Sharpe ratio, which we've been declaring ever since we founded our company. Because if the Quant, which is that most popular mutual fund now, Quant, if Quant is generating some amazing returns, has anybody ever calculated their Sharpe ratio and beta? So while the run is good, while the accident has not happened, and while you've not missed a turn in a mountain and not gone downhill, you're all having a great ride because it's thrilling. But Sharpe ratio and beta are very, very important metrics of any portfolio. You can calculate all of that for your individual stock. You can calculate it for the whole portfolio. But ask yourself, how much risk are you taking to generate one extra percentage in returns? And your since I mean since you ask how to, because we Srishti and I discuss how to select and deselect either a mutual fund or a PMS or investment option. And most of the doctors are DIYs because they're very, very intelligent people I've seen. So, so always have a formula to calculate your risk and your risk appetite and have a quantification of it. If you have a quantification of it, you'll be fine. If you can't quantify it, you'll get into trouble. Some of the mutual funds are charging 2-3%. Remember that if somebody's charging, and some of the PMSs are charging 3%, right? That means every 10 years, 30% of your wealth, 3 into 10, 30% of your wealth is going away as fees, right? So some of our schemes, we don't even charge any fees. We say that unless we cross a 7% return, we'll manage your money for free. So it's like having a skin in the game, right? All my employees and everyone's very, very cross and unhappy with me that how can you not charge fees from your clients and only charge after a certain hurdle rate. But I said that, if my mother was to invest her money in a bank FD and she was getting 7.1% without taking any risk, is the only risk is the government of India risk, then how can I actually charge a 2%, 3% fees without even knowing what return I'm going to generate? So I said the best way to do is having a skin in the game. That's all Fugazi, what we do, contrarian approach. But this just, I'll take a moment because I don't like anything, but just to let you know how we operate, what we've done, and I'll take less than 30 seconds on it. Our returns have been like this. Our Sharpe ratio is nearly 50% more than the overall market. Our beta is nearly 32% less than the market. That means volatility. And our standard deviation is lower. And our returns are 5, 7, 10% more than the market. So we have less than 2 or 3% churn ratio in the way we manage our client money. We don't churn. We don't buy. We are happy to leave money on the table. But if we buy, then we don't like to sell, which means that we are not just generating brokerage fees for our brokers, right? We like to hold stock, and I keep waiting for a bad quarter. If I love a company, I keep waiting for a bad quarter because a bad quarter is a great opportunity or a bad news in that company. Because a company can have a bad quarter, a company can have a bad year. But a company fundamentally, with its character and its culture and its uh, underpinnings are great. A company cannot become bad unless something changes fundamentally, for which you have to be well informed. So we can just continue to remain invested, wait for bad times, bad quarters, never get excited by results. And if the result is bad, we buy. Else, we keep waiting. So sometimes, even with my clients, I can sit on their cash for 1 year, just having parked in liquid funds and leaving all the bull market behind, because they must understand where I'm coming from. And I must have only those clients who know what I'm talking about. So that's how we operate. And then, yeah, I mean, we are very boring, very, very simple, nothing to nothing to write home about. It's just a privilege that I'm speaking to you guys. Otherwise, anything that I do or say is no rocket science, and anybody and everyone can do that. So pretty much that's it. I hope you enjoyed a little monologue from my end, and I don't know what's the next step and how we can have a conversation or whatever. Over to
Yes,
you
sir.
guys.
So thank you so much. It was a very insightful talk. And I would take permission from Vijay sir and say what he says. Like I was quite afraid for a couple of months, Vijay sir, like what is happening in the world, and I don't understand why our markets are rallying. And he was like that there is a very thin line between being scared and being cautious and
Mhm.
masterly being aware. So the very nicely you had also put up that you are not sitting in cash, you are invested, but in a meaningful, mindful way, that this drama and or let's say this party is not going to last forever. It will revert to the mean, but let's enjoy it while it is there. So yeah, it was a very insightful talk, sir, and we got to learn a
Yeah,
lot. I
we
would
should we should always be very bullish in the long run, because if we are not bullish, then there's no
yeah.
point in being alive, right? So we
Exactly.
should be hopeful, we should be bullish, we should be very, very positive. But always remember that there is a thin, fine line between bullishness and foolishness.
Yes.
And if we realize that, I don't think anybody even needs a fund manager. Nobody needs a fund manager. Everyone can do a DIY.
It's more about the psychology and why you need a professional person who would hold on to his nerves when
Yeah.
everything is going haywire. So we have couple of questions, and I would request everyone who is hearing and is with us right now to please put up some questions in the Q&A. I would ask you some questions which I already got. So there's a question on commodity prices, that how do fluctuations in commodity prices such as oil and precious metals impact global economic stability and investment decisions?
Yeah. So I don't understand too many commodities, right? Because we do not know what's happening to oil. What are the top 4, 5 commodities? Aluminium, nickel, gold, silver, oil, natural gas, right? Right.
Steel
I
and
also,
coal.
yeah, I also do a bit of a punt once in a while. But what I do understand is gold and silver. You do not know if tomorrow there was a war and the entire Red Sea was to be blocked. The the oil prices can shoot up to 120, 130, $140. But who knows? You can't see just a candle. A lot of people say, no, 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 this candle is now hit the bottom and it's at its support. How on earth even God cannot predict?
I remember reading a book, and there was this fund manager, and his new trainee and new intern told him, "Sir, I can see a reversal, and I'm sure this will reverse, and we should buy now." And then he calls another broker. He's like, "Just sell this stock and this $1 million," and then suddenly that breakout becomes a fake out, and
Right.
then he tells his trainee, "Look, now where is your reversal?"
Uh,
So yeah, so all obviously they are the buyers and the sellers who are making all those candles.
so nobody can predict what's happening to oil, what
Right.
happens to the Red Sea tomorrow. So do not try and buy commodities on technicals. Technicals have no role to play, right? Technicals are lag indicators. Lag indicators cannot define what Netanyahu is going to do, what Donald Trump is going to do tomorrow, where the sun's going to rise from tomorrow. So I do not recommend that if somebody is not a specific subject matter expert who knows how much oil is coming out, what decision OPEC is taking, stay away from commodities. They can be extremely volatile. They can wipe you out. The only two commodities that we
Right.
understand is gold and silver. And gold and
Right.
silver is a philosophical investment because fiat currencies are in trouble. Dollar
Right.
is in trouble,
Yes.
right? People are accumulating gold all over the world. The central banks are accumulating gold and precious metals. So
Right,
that's
sir.
the fundamental premise. You cannot see a candle and then hope to invest in natural gas and and crude oil. So
Totally.
yeah, and I don't understand it either. Because how do I
Right.
know what's going to happen to a commodity price tomorrow morning? Who's going to do what?
True.
I'm being foolish. I'll be misleading somebody if I even opine on commodity.
Got it.
Nobody on this planet, no Mr. KDR, no CNBC, nobody knows what's going to happen to a commodity. Seeing a candle.
True. I'll go to another question, sir. That with the recent changes in interest rates by central banks globally, what impact do you foresee on the investment landscape?
Yeah, so interest rates are at a life high, right? Indian interest rates are high, US interest rates are high. So in central banks always operate on a lag because not too long ago we heard that inflation was transitory, right? We all
Right,
heard that
sir.
inflation was transitory. And inflation was transitory, and suddenly we realized that no, it was not. And America had to take its interest rates up from 0.25% to 5.25%,
Yes.
right? Five. 100 basis points.
Yes.
So
And we are
now,
imagining rate cuts since October. It's
correct,
another October coming now.
correct. And now everyone realizes that inflation is not coming down. I'm in England. I used to buy a pint of milk here when I used to live here for a pound. Now a pint of milk, a gallon of milk is costing £4. I mean, raging inflation through the planet, and I don't know the reason for it. Either people are drinking too much of milk, or too little milk is getting produced, or people have become extremely wealthy, that people are, I mean, we do not know. So, but when central banks start cutting interest rates, for the first few quarters or for the first few weeks, it's going to generate a lot of positivity. But interest rates will only be cut. And if you see historical patterns of interest rate cycles, it will most likely lead to a recession because they will still be lagging, and the negative effect of very high interest rates would have got discounted into the global economy. So, I mean, I don't know whether I answer your question right, but I think that interest rates are very high right now. They should have already started cutting it because whatever you do, it takes a few quarters to take effect. Now, even if you cut the interest rate now, the effect of 5.25% rate overall, in especially in the largest economy on the planet, it will still have its negative effect for a few quarters. So interest rates will, for the very, very short term, if I can hypersimplify my answer, will inflate the asset prices even more and then collapse the asset prices, because that's what has happened in every
Right.
increase and cut cycle, unless it's different this time. Because it's different
Right.
this time is also a very popular sentiment that we all
Oh
tend to have a
God.
bias towards, right? So if it's
So
different this
we,
time, it's different. But if history repeats itself cycle after cycle, then we are heading into uh, from an India perspective, a tsunami in a very short term. Long term, we are all bullish, hyper bullish. I'm very,
yeah.
very bullish. Short term, a tsunami, but globally, a tsunami that will last a bit longer.
Yes. So we have a comment and a question from Vijay sir. He's saying that very well articulated. I'm a big fan of your writings. We are risk averse because we are old bandicoots.
Mhm.
But I wonder whether our experience sometimes works against us. I think that's the feeling with
100%.
everyone right now who is
What
risk
a lovely
averse.
thought. What a
Yeah.
lovely thought. Sometimes I feel, am I a bloody fool? Sorry to use the thing. Because everyone is doubling their money every year, right? And I'm not doubling my money every year. So I said, why have I not invested in the railway stocks or the shipping stocks and the PSU stocks? Then I slap myself in front of a mirror and I say, look at a PSU ecosystem. It's not that Tesla is giving orders. We have not been able to develop a Tejas aircraft for the last 20 years. 20 years we are trying to develop a Tejas, right?
Right,
A
right.
domestic aircraft, fighter aircraft. Uh, when a PSU company or a government gives order to a PSU company, right? Thereby maintaining the underlying corruption. Corruption's not gone anywhere. The character and the nature is all the same of every PSU company, right? So either the government is giving an order or another PSU's company is giving an order to a PSU company, thereby protecting their profits and revenues, right? So every order is coming at whose cost? The fiscal deficit of the nation or the taxpayers' money. Because if the money was being generated or the order was being generated from US or China, or if somebody feels that Hindustan Aeronautics Limited is making the best aircrafts in the world and a Boeing and the Airbus are going to go bankrupt because we started making the best aircrafts in the world, then it's fine. But if we are just trying to struggle to make Tejas for the last 20 years, where the Air Force just 2 days ago said we are not happy because they're not flying well, right? And just burning the taxpayer money and the government money and the increasing fiscal deficit of the nation. And then These PSU companies are giving handsome dividends to whom? To the government that owns 90% of these PSU companies to then feed the fiscal deficit. So you know what a Ponzi scheme look like?
Yes.
I mean, I hope I won't be quoted in public domain, but the entire PSU system is nothing but a Ponzi scheme. It's like playing Monopoly within a home within your family members. You're playing a Monopoly within your family members, and then whatever extra dividend is there for your mismanagement, because obviously people are, I mean, shareholders are also getting dividends, but shareholders are only 5-7%, public shareholders, 5-7-10. Most of the PSU companies are like that, right? 90% is owned by President of India. And the dividends are going back to the government, thereby uh, what you call giving them the money to become even more fiscally frugal
Right.
or or fiscally imprudent, not frugal,
Right.
imprudent, sorry. So yeah, so what was the question, Srishti? I
So
mean,
the
have I
question was
taken?
about the central banks. Yeah, I think you answered that about the interest rates, and has the Fed always been late about cutting down
Yeah,
on the
yeah, yeah.
interest rate? So yeah, well answered that. Yes, historically they have always been late, but whether it is different this time, we'll know. We'll know. Time will tell us. So we have another question from Vijay sir. His question was in the context of recently Indian markets scaling huge walls of worry. Example, election results, US markets cracking recent days, a budget which is specifically taxing capital markets, yet the Shivji ki Barat is merrily chugging around. Can we use some methods to exit such bubbles?
Yeah, I mean, there is no concept as wall of worry, you know. Just because a share price goes up, just because every dip is bought, doesn't really mean that the wall of worry has been climbed forever. Too many middle class people are thinking that, are having stupid thoughts that stock markets only go up. And when Indian saving rate used to be 36%, it's come down to single digits, right? So we are not saving any money anymore. Credit card delinquencies, retail loans, everything is shooting through the roof. So wall of worry is not a justification of stupidity.
True.
Wall of worry is a imprudence of converting your family silver into equity in the companies which are struggling to grow. You know what is happening to banking, right? I mean, everyone is so gung-ho about banking. I must be the only fund manager in the country who has zero investment in any banks, because my logic is very simple. Banks are governed by human decision of their managing directors or the government or the PSU or whatever. Banks collect money at 7%, give out money at 10%. The 3% margin has to absorb the cost of running a bank, the cost of salaries, everything, including the frauds, including the mistakes, including the delinquencies, including everything. A business that has 3% margin, I don't want to be in that business at all, ever, even though we will continue to grow or whatever. And every bank manager, Shashidharan Sahab, comes on national channel and he says, there's no growth in deposit. Retail is struggling. We are hardly growing. And say, no, no, no. He was not as negative as we expected him to be. So the price must go up. I mean, can you imagine
Yes.
stupidity of.
Nowadays, it's very interesting. Yeah, as you said, it's an amusement park that the results are as per expectations. So the
uh,
TCS
the
results were
stupidity of
not good, but we expected less. So that's why we are happy.
TCS. TCS managing director CEO said in public domain on TV, he said, I
Yes.
don't know when growth will come back. I do not know what future lies. And TCS share was 8% up.
Yes.
I
Yes.
mean, amazing, man. I'm fine. I'm fine to be out of that rat race of Indian. I'm scared of banking because I have seen enough and more of every bank because I've been around for 30 years. And I have
Yes.
visually have very, very vivid memories of how banks operate.
We
So
have
even if
another question, sir.
yeah,
Okay, sorry. What are your views on this year's budget for us investors? Should our investments be more globalized?
see, I invest in global markets. I have a very large portfolio in American markets. But American markets, I operate because I've been investing there and managing a few some wealth for my clients and all in American markets. So I've been around for a while. The valuations there are also out of the roof because those countries, India might still grow at 6, 7, 8%. Those countries are struggling to grow at 2, 3%. So if those countries are struggling to grow at 2, 3%, how can a company there be trading at 30 P? In India, 60 sounds low. There, 30 is also like terribly high. So India is the place to be. You should remain invested in India, but have muted expectation and don't and be cognizant of risk. I think that's my advice.
Yeah.
So no need to go global because this is the only country that's growing. This is the only country that's doing so well. This is the only country that has the potential to double, treble, whatever. America can't go from 19, 20 trillion dollars to 40 trillion dollars,
True.
considering that they have a debt of 300, the global debt is $300 trillion and direct and indirect debt of America is nearing $100 trillion, direct and indirect. So India is still all right. India will still grow, right? So India is the place to be. But what we must hope is that rather than a handful of companies, because there's no depth.
Hmm.
So investable surplus has doubled and trebled, but they're not, the companies where you can invest is not
Hmm.
doubled and trebled. So
So
there is,
too much money
so their
chasing too
valuation
few
has gone
good
up.
companies.
Yeah, the valuation has gone up double, treble, 4 times. And nobody's saying that, oh man, something's wrong. So
Right.
wait for your time. अपना time आएगा और जरूर आएगा. And you should not have be greedy. You should only hope to have the last laugh. That I preserved wealth, I did not waste wealth, I did not make a stupid decision
Got it, sir.
and destroyed my family wealth.
Got it, sir. So yeah, thank you so much, sir, for today's talk. It's 9:45. I think if there are any, I think we have answered all the questions which were asked. And I would like to just put up a concluding remark, sir. Thank you so much. It was a very, very insightful discussion and talk. And we look forward for this communication for a very long period of time. And we will get to learn a lot from you. And yes, it was a very, when you said in the beginning why this meeting is on the last Thursday of every month. So I just wanted to put up to explain on a jovial moment is that yes, we see FNO trading going very rampant amongst the youngsters. We see our computer operators who are just earning 10 to 15,000 a month, the receptionist earning around 10 to 15,000 a month, doing option buying because they want to make quick money because they see that, oh, that person who was sitting next to me, he had invested 1 lakh in XYZ company and now he has tripled his money. So why not to jump in FNO? Yes, the frenzy and the party has penetrated quite a lot. And yes, so yes, you rightly said that we have to be cautious in the short term and in the long term. Yes, I think we are the best country to be invested in. So
Thank you,
thank you so
Srishti.
much, sir. Thank you so
Very,
much,
very
sir.
kind of you. Lovely. Thank you for
Yeah,
this
and
opportunity. It was very
thank you,
nice.
sir.
Yeah,
And we will be in touch on Twitter
absolutely.
and on phone, and we'll get to hear more of your insights. Thank you so
Lovely.
much, sir.
Thank
All right.
you.
Bye. Keep
Disconnecting
inspiring.
over and out. Have a very good evening. Bye
You
bye.
too, sir. Bye-bye.